is a small venture fund a small version of a big venture fund? And I think in most cases, the answer is no. It's actually kind of a different animal.
Welcome back to the Data Minute Podcast. I'm your host, Peter Walker, head of insights here at Carta. Today, I was joined by Charles Hudson, the only investor at the small pre-seed fund Precursor Ventures and one of my favorite intellectuals about what's going on in pre-seed startups. If you're not subscribed to his Substack, I highly suggest you do so. It's chudson.substack.com. And we talked a lot about the articles that he's been writing there, specifically 3 points. One is on the difficulty that he's finding syndicating pre-seed deals. And that got us into a giant conversation about multi-stage funds versus small funds and the different kinds of investing that will work in today's AI-dominated environment. The next thing that we talked about was whether or not small funds even get to play in that AI marketplace. There are a lot of different funds that are trying different strategies around AI investing. I think Charles has a very clear-eyed view of how small checks can still play into those companies. We then wrapped up with a long discussion about safes and the ways that pre-seed investing has changed over the years. We also wrapped up our conversation by talking about Charles' time as the board chair of the National Venture Capital Association, the lobbying group that supports VCs, and his points around how more VCs need to be engaged in policy and how things that happen in Washington really do affect emerging managers across the country. Charles is honestly one of my favorite people to talk all things startups with. Let's jump into it. Charles, thank you so much for joining me.
This is a pleasure. I'm so excited to be here.
You are in our new wonderful side studio. What are your thoughts?
It's gorgeous.
Thank you.
It's gorgeous.
That's mostly our friend Josh here. That's been doing a lot of hard work on that. But I wonder if you could start by just giving us a quick, potted intro for Precursor.
Sure. So I started Precursor Ventures about 10 years ago. Pretty simple hypothesis. I feel like there's a couple of solved problems in venture capital. I'm curious what you think. I think we've solved the problem of funding repeat founders. That's like a solved thing. If you're a repeat founder, we kind of figured that out.
I think we doubly solved it this year, right? That seems to be the only kind of folks getting any capital.
Sure feels like it. Yeah. I think we've largely solved funding for YC graduates. We funded the first 25 people out of whatever your academy company is of the moment. And I think most people have figured out I can fund my neighbor, best friend, college roommate, business school classmate. I felt like when I started Precursor, there was this one frontier that no one felt like was really their responsibility, which is the person who's not tightly connected to the sort of inner networks of VCs and doesn't have product traction. And I felt like being in the Valley for 25 plus years, if you had product traction, there were people who would meet with you, even if they didn't know you. We call that strangers bearing data. You could probably get a meeting. Hard, uphill battle,
Sure.
But you had something. And if you have the social connections, you'll get the meeting. Doesn't mean you'll get capital, but you're going to get in the room. And I met all these founders who had neither. And I was like, that doesn't mean they don't have good ideas. They're just lacking the currency that most VCs want to see.
Do you think that there's a lack of appetite in most VCs to dig through all of those people? Because that probably comprises a much larger group of people.
It is a completely inefficient way to find gems.
Right.
If you think all right, I could just meet people that I really know or who are referred to me by a warm connection.
Or have a stamp.
I could just meet those people all day. I'm like, but that's the pool of people that everybody meets. And I'd argue most of those founders are actually pretty intelligent and tend to gravitate towards a fairly narrow set of brands. And if you're one of those brands, you should dominate those sectors.
Go deep in that thing.
Go deep in those things, and you should have whole processes and teams that are focused on making sure you don't lose those deals.
Yeah.
But I felt like, what about all these other great first-time founders? It's funny, when I was at Uncork, before I started Precursor, we met a bunch of people that had that profile. If I think about when we met Edith from Launch Darkly, people didn't know what a feature flag was. I certainly didn't know what a feature flag was. And Edith, right? And Edith was clearly really compelling, but the case for Launch Darkly was early. I think about the guys from Drone Deploy when we did that company and was at Uncork. Bastian from Postmate. There were all these founders I met who were clearly really talented people, but they just didn't have all of the merit badges or stamps or social proof, whatever term you want to use. And I was like, well, what if we built a fund that said we're going to center most of our time and activity on this sort of talent scouting activity? And sort of the big aha for me was most venture firms, if you're an investor in the company, you know the CEO and you probably know most of the C-suite. If any of those people leave, you're probably going to get a call if you're close to the CEO. and maybe even the select direct reports to that C-suite. Then as the company grows, you get this tier of middle management individual contributors who weren't one of the first 25 employees, probably not that close to the CEO, never shown up in the boardroom. When those people leave, you don't get the call.
Right.
And oftentimes those people walk out with really practical, tactical knowledge about some element of the company's business that goes on to be like the basis of their next startup.
Right.
And I was like, what if we just said we want to be the investor of choice for people who are effectively outside of the inner ring and who have good ideas, and we will let the amazing multi-stage and top-tier funds fight over the well-known, super qualified talent. We get our share of that too, but that's not the focus of the fund. And we're going to try to be the investor of choice for the people who are kind of doing it for the first time, maybe from a slightly outsider perspective.
So do you actively make it a point to go to the companies in which you are invested and meet all of the IC talent?
I tried that once, and I think it kind of freaked the CEO out.
That was my latent question, was like,
it was sort of like,
what are you doing?
I don't like the fact that you're here poking around in my org.
Did you bring the big golf-sized check? And just like walked around and you were like, who wants it? Who wants to start this company?
Sat out in the parking lot and waited and see who came out last. But no, thankfully there are now software tools that make it easier for us to do this in a more passive way.
Yeah.
It also turns out we don't have to do this as much because I've learned many of my peer VCs meet the kind of founders I want to meet. They just don't fund them. So the other way to find these people is just to tell everyone in my network, when you meet these people, if you think they're qualified, you should send them my way.
Interesting.
And we get a lot of referrals from other VCs, particularly Series A VC funds, who say, hey, I met this person. They worked for one of my startups. The CEO says they were good, but can't really speak specifically to their contributions. I don't know them well enough to give them a check. Here, you take them. And I think in some cases, it's those VCs trying to be helpful to somebody.
Yeah.
And say, hey, I'm going to introduce you to someone who I think could work with you. And we've oriented our whole fund towards working with people who are pre-product market fit and who maybe are doing it for the first time. So I'm like, I'm happy to take all of those intros and people send them.
That's, a beautiful pathway into the first thing that I wanted to talk about. So for any founder, or I'm sure the investors are all reading, but any founder who's not already reading Charles on Substack, chudson.substack.com. Right. Did you give it a name?
We call it Venture Reflections, which I probably should come up with a better name.
It wasn't in the URL, so I was like, does he call it C. Hudson? Because that's cool. I like it. It's like a clothing brand.
It tells you what I thought would happen when I started the Substack. Right. This is just a place for me to like park thoughts, and it's turned into more.
Yeah, it's definitely turned into more than that. But you wrote an article recently about the changing nature of pre-seed syndication was the title. So this gets into these funds who send you founders that are not part of their thesis, but are perhaps part of yours. But the part of the article that was very interesting was that you're just finding it harder to find dance partners amongst the pre-seed community than before, whereas it's kind of counterintuitive. Like a lot of people around venture say the earlier you go, the more active the space, but you're kind of finding a little bit of the opposite.
I think what we're finding is, so when I started Precursor 10 years ago, in the late 2014, early 2015, there were a set of firms that were in our same spot. They were sub $25 million first-time funds. They were just getting started. And some of those people have really scaled. And they don't do what we do anymore, and they've graduated. I'll give you an example. I distinctly remember when Namdi and Aaron were starting 645. And we were at YC Demo Day, and I was raising my little first fund, and they were raising their first little fund. And we were both like, I hope we both all collectively made a good career decision here. But their newest fund is enormous.
Right.
They've earned it, and they're phenomenal investors. But that's a group that now does something different. I look at when Gaurav and Anamitra started A4, it was a much smaller fund. They're still pretty committed to pre-seed, but they've gotten much larger. And so we periodically do this analysis internally. Who are we co-investing with? And there are funds that no longer exist that started when we started, funds that have dramatically scaled AUM and no longer do pre-seed, and other funds that have gone more vertical specific. And we looked at our co-investment partners, and it became really clear to me that we didn't have the same people. So I actually started going to some of my friends who I think have really excellent judgment as fund-to-fund managers and said, who are the new generation of people that I need to get to know? The people who are raising $15 to $20 million funds, who you think have good judgment, who I should get to know.
Yeah.
Because I need to rebuild this network.
Do you think it's always this transitory? Like certainly I would imagine that at the moment fund, shutdowns are obviously probably a bigger portion of that cohort analysis than you would hope. But the graduation thing, I mean, I think a lot of VCs will say, as we were just talking about off mic, I'm going to do a test, I'm going to do a pilot, I'm going to do a demo fund, and then I'm going to get big quick.
I think what you said is 100% true. And I saw this at Uncork because when we started, we were little, Felicis was little, Floodgate was little, Freestyle. There were all of these like kind of little, even True was like pretty small. And there were certain firms that just said, we have a strategy that will allow us to scale AUM and become much larger. And those firms graduated and we just didn't see them anymore in sort of the seed deals.
Yeah.
And I think the same thing happened in our cohort of pre-seed funds. There were some people who were really successful and decided to scale their franchises and get much larger. So I think it's part of life. And I think what I've realized is I just really like pre-seed investing. I have no aspiration to build a big multi-stage firm. I have no aspiration to build some gigantic AUM machine, like no shade to people who want to do that.
We love gigantic AUM machines.
Those folks are doing better than ever in venture.
Absolutely, yes.
But I looked at it and I said, if we're going to write a $500K check and we want that check to be meaningful in the context of our fund's returns, we probably can't get much bigger than $100 or $125 million for a single fund because 100x cash on cash return is a big win for 99% of VC firms.
Yes.
And if we do a $500K check and we get $50 million back net of dilution, that should move the needle on the fund. You get above 120 and you're like, you need 3 of those just to get back to par?
Yep.
That's probably tells you that there's like, and I'm like, I totally accept that there's a strategy dollar cap on what we do. And we have to either accept that cap, believe something different than the market believes, or change our strategy. And I'm like, I don't want to change our strategy. So we're going to live within this like $100 to $120 million strategy cap. And it just means that's it. That's what we have to work with.
Your check size dictating your strategy is one of the like most common things you hear across venture. But I hadn't really clicked for me until you just said that most VCs, or I don't want to paint this too broadly, but a lot of VCs expect that strategy to change because they expect that check size to grow. So fund 3 is going to be a bigger check than fund 1. And that seems like you're making a lot of assumptions on your ability to move up.
And I think everybody tells themselves the same story, which is like, well, the companies I can access at 500 will be the same at 250. We'll have to be a little bit more sharp elbowed. We'll have to move people out. And the other thing I've always believed is access to great companies is the only thing that matters. And if you have a strategy and a check size that means you can't access great companies, you should change your check size. Mm-hmm. And I was like, in $1 million pre-seed round, the only reason we won't get a $500K check-in is a founder chooses somebody else that they'd rather work with, which is a loss, and we should pay attention.
Yep.
We get to the deal so late that there's not 500 available, or the person's raising so little money that 500 kind of like consumes the whole round.
Will you give them 200 if you get there late?
Yeah, we will. So I would always, I'm of the mindset that it is better to be in a great company for an off-model check. It's interesting. LPs always ask me, what's your ownership target? I'm like, we don't have one. We have an entry price target. And I'm like, I would rather fixate on entry price because it's much easier for me to model how a low entry price turns into a big win when the company works than to say, all right, we need to buy 10% of the company. The company is raising at 20 post. So I have to write a $2 million check. The odds of that $2 million check turning into something big, unless it's Wiz or something like that.
Congrats to
Wiz.
According to the headlines, we're not sure it's happening.
It's much harder. And so I just told our LPs, our ownership will fluctuate within a pretty narrow range, but I'm going to focus on getting into companies where the entry price math works for our fund.
Are you setting aside a bunch of reserves? Is it like 50-50 or?
This is the other, we have a lot of things that I think are internally consistent with our model, but at odds with what LPs expect. We've historically been a 75% first check, 25% reserves fund. And part of it is that, our average entry price is kind of think 5 to 7 post.
Yep.
And if our A's are getting done at 40 to 50, I was asking myself, okay, this company is raising money at a price that's 10x our entry price. We know more about this company than we did before, but I have 2 choices. I could write a check into this company at a dramatically higher price than the price we paid to get it in, or I could take that same check and go buy 8 to 10% of a brand new company and just take whatever future dilution I get. I kind of would rather buy 8 to 10% of companies that I'm really excited about and maintain as much of that ownership as we can up to the A, then continue to dollar cost average into these companies at much higher prices, unless I'm very, very, very convinced that something special.
So you'd view that as like sort of a risk differential. It's like it hasn't been de-risked so much at the A that it's worth the double down.
That's right.
Yeah.
That's right.
That's
And most LPs are like, that's the opposite.
right. They're like, we want you to concentrate your bets.
And I'm like, I get it. If I ran a Series A fund, I would absolutely load up on the B of the companies that are working, because a Series B company is substantially more de-risked than a Series A company. We're taking 0 to 1 bets on companies at pre-seed, and but by the time we get to the A, they're at some arbitrary amount of ARR below $5 million, and probably honestly more questions than answers about the business still to be figured out.
Yeah. The modal outcome for a Series A company is a 0.
Yeah.
And I mean, totally is true across all ventures. So that makes a ton of sense. But actually gets you to another question, which leads back into your original point around it's difficult to find syndication partners, which is these multi-stage funds coming lower and lower. Yeah. So the idea of being able to play in these check sizes when you're actually competing against Andreessen or someone like that, and there's a lot of people in venture who will just say they're taking option call flyers on these companies. I think that's a little extreme. I wouldn't call it that, but they are playing a slightly different game.
Yeah. It's like I always get mildly offended when people call my model spray and pray. I'm like, it's not spray and pray.
Right. Yeah.
We know what we're doing. We have a plan. Right. And I think this notion that
we are praying. We're believers.
There is no success in venture without prayer. But I think this notion that the Series A funds aren't exercising some kind of discipline and that these are all that's also false. I think this is probably one of the most consequential decisions or changes in venture that I've seen in my career as a seed investor, because 10 years ago, if you told a founder, don't take multi-stage money, there's signaling risk, they mostly believed you. They don't believe it anymore.
They don't believe in signal risk?
They don't believe.
Or you are the wrong messenger.
It could be I'm the wrong messenger. I think in general, most of the repeat founders I've met are like, I don't care about signaling risk.
Yeah. If
I take a check from Excel or Sequoia or Andreessen, and I cannot subsequently clear their Series A bar, I don't have a good company, and I'm actually okay. Yeah. I'm okay. I'm not worried about signaling risk. I'm only worried about building a great company. I also think, a lot of repeat founders I've met are like, I don't want to do this on $2 million.
Yeah.
I want to do this on $5 million, but I also am not selling 20% of the company for $5 million.
Yeah.
And so you have this now, the new symbiosis where the multi-stage funds, in my opinion, have gotten so large that raising a dedicated $500 million seed vehicle alongside a multi-billion-dollar early-stage fund is something that is well within their ability to do consistently.
Definitely.
So if I were what would I do if I were a multi-stage fund? I would raise a dedicated seed vehicle, and I would just focus on high probability repeat or high signal founders, and I would be mostly price insensitive, which is kind of what they are.
A bit. It feels odd to take the risk-taking nature out of venture a little bit there, right?
I think they're still taking a substantial risk. I think they're just like, on a risk-adjusted basis, we think, the person who worked at CrowdStrike who leaves to start a cybersecurity company is probably more likely to be successful than like somebody who doesn't have a background or who worked at a less prestigious company and was less senior.
Right.
And we're willing to pay actually a pretty substantial premium for two reasons. One, we have a big fund and we can afford it. And two, if it really works, we have this other gigantic vehicle over here that can pile in.
Yep.
And so I don't think it's so much option taking. When I talk to them, they're like, this seed fund we have is dedicated to a really specific founder profile. And when we find those people, we are going to do whatever it takes to win. And if winning means writing a bigger check at a higher price, we'll do it.
Yeah.
And I think that's actually it's a rational strategy. And I think what it means is it's taken that tier of founder out of the broad seed market, because they're like, well, why would I raise even like 2 on 20 from a good seed fund if I can get 5 on 40 or 50?
Right.
And that's part of why we've been kind of skeptical about AI as a pre-seed opportunity, because most of the really good repeat people are not going to raise a small round. They're going to go raise a large amount of money from a multi-stage fund, and they will likely succeed in raising that.
Yeah. Back at chudson.substack.com. Another wonderful article on why it's hard for small venture funds to play in the AI game. Yeah. Now, I think it's sort of, it's weird how quickly this shifted, but it's a little bit common knowledge, like AI companies are raising for higher valuations, higher fundraising, blah, blah, blah. Do you see any distinctions within the kinds of AI now that we are a year and a half, 2 years into this, where that's not actually always true? That was that exciting.
I was like, wow. So I think there's two things I've noticed. One is I've read a ton of articles about people's interest in consumer Gen AI, and I've seen almost no investing activity actually flowing to those companies. Maybe they're being done quietly and just not being announced, but I don't think that's the case.
Can you give me like a flavor of what consumer Gen AI would mean to you?
To me, it's sort of like, whether it's the digital girlfriends, whether it's the video stuff, the things that are really designed to be put in the hands of the consumer. Maybe something like Suno, like audio, things like that. Can of soup. But there's a bunch of things out there that have attracted some capital. But like, if I look at the amount of attention I've seen people spending on the consumer side, it doesn't match the investment activity. I worry that maybe we overdid it on the B2B infrastructure side for AI.
Wait. We overdid it. VCs and startups overdid it.
I know.
I don't know.
It's hard to believe.
I don't really get it.
I don't know. In most of my career, you do dev tools and infrastructure once the landscape's a little more stable and you know what matters. You're like, oh, this is a persistent problem. This is not an ephemeral problem. This is a persistent problem. Someone should solve it. And I think in some ways, I told my LPs, it feels like we're speed running AI. It's like, I don't know, for most other cycles I've been a part of, we make a bunch of investments and everyone's like, okay, let's figure out which of these things are actually working. Oh, like, turns out that, like, if I go back to mobile, turns out these like little WAP apps, that wasn't really a thing.
Right.
We actually needed like full 3G on a phone.
Right.
Like, good thing we didn't like pile into those, but applications on phones are going to be a thing. It feels like we're speed running AI and we're just like making all these investments without enough time to figure out, like, did that thing that we thought would be a big problem turn out to be a big problem? Well, it doesn't matter. We've already dumped a bunch of money into that thesis. And so I really worry about what that means. And I think for small funds, the foundational model stuff, they're so expensive to build.
Yeah.
You can't do anything with $1 million pre-seed round in that universe. So which means you're sort of left with dev tools and applications. And most of the dev tool companies I meet were started by people who worked in big AI companies who were like, this was the problem with our foundational model. Those people are going straight to Sand Hill Road.
Right. Yeah.
And so I'm like, it kind of leaves you with like
Back to your original
stuff. Right. I'm like, it's just not.
Yeah.
And I've always told my LPs, there will always be a couple of really hot capital intensive sectors that are just not good for pre-seed. Like some of the climate stuff I saw 3 years ago, I'm like, wow, direct carbon capture, that's pretty expensive.
Sounds expensive.
Like probably not great for $1 million seed round. Like it's okay for something to be out of spec for your strategy. I think that's totally fine.
Yeah. Especially if that thing out of spec is the hottest thing on the market right now. Which, I mean, I'm sure that LPs, it like makes those conversations more difficult.
I've told a bunch of them, like, this is why we're not doing it. They're like, but literally everybody else we respect and admire is like all in on this thesis. I'm like, they're operating a different fund and a different strategy.
Right.
It's funny, we have a bunch of like CPG companies in our portfolio that are doing exceedingly well. And that's like a
narrative violation.
It's not supposed to work.
Yes.
And I'm like, well, we have a handful that are working really well. And so, I don't know, I try to always ask myself, like, is a small venture fund a small version of a big venture fund? And I think in most cases, the answer is no. It's actually kind of a different animal. And so I'm like, we're just a different animal. We're not like a mini Andreessen or a mini Sequoia. We're like a full-size precursor. And like the things we have to optimize for, the problems we're solving are actually different than what those funds are optimizing for and solving for.
So then this another beautiful transition for you without even trying into the idea of proving to LPs your difference. Like, how do you make the case that they shouldn't be judging you as a small Andreessen? They should be judging you as a, regular, normal-sized precursor.
I think another thing that I've noticed in talking to LPs, and, I actually think this dramatic upsizing of, the biggest funds in venture have always been bigger than the average fund, but now they're like an order of magnitude bigger. And I don't know that everybody in our ecosystem has fully digested what that means on the LP side. Because I've talked to a few people who just said, well, I could go to a handful of Sand Hill Road firms and they could be my entire soup to nuts venture strategy. They have a seed product, they have an early stage product, they have a growth product, they have a crypto product, they have all
crossover products. So they go public.
They'll treasury manage this stuff. Like Jake.
Yeah.
And they're like, I could get all of this stuff under one roof with a brand that's well respected, that will not create any internal friction for me at my firm.
I won't get fired for buying IBM of venture.
That's right. Like, why shouldn't I just do that? And I'm like, it's maybe not the worst idea if your goal is, I want a very easy to manage, small number of relationships they're going to cover. If you're just like, look, I think Andreessen and Sequoia will eventually see all of the great companies. Yeah, I'll give up some of the gain by getting them early. I've had a bunch of LPs who've just said like, hey, we have questions about the long-term return profile for some of the mega funds. We want to at least have the option of having some of the smaller, nimbler funds, because historically, those small, nimble funds, we can't put $100 million into them. But the multiples and returns we've gotten from those funds have been substantial.
Right.
And so we're always going to have a portion of our fund in those. So I think what it means is if you're going to be a small venture fund, you have to have a really good story to LPs about how you're going to dramatically outperform.
Right.
Because I think it's easy to just say these large platforms can absorb, unless you're like a very, 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 very large sovereign wealth fund.
Right.
They can pretty much absorb what you want to give them.
Yeah.
And you could be done with your whole strategy by giving all of your venture allocation to 2 or 3 large funds, and you could probably feel pretty good about that decision.
Do you feel as though you have to convince LPs of the outperformance potential for small funds? Or do they sort of intellectually accept, yes, we know that the smaller funds have higher skew, right? That the distributions are wider? Or do you have to like go ahead and make that case?
I think most of them understand, we'll say arbitrarily, sub 100 or sub $250 million funds, you are much more likely to get a high multiple outperformer fund from they've all seen the data, you've seen the charts. They all know that intellectually. But the question is like, but that's like only applies if you pick the right manager.
Correct. That's about manager strategy.
And it's manager selection, and like there's, let's say, $25 billion plus funds. You can get your arms around that. There's 5,000 sub $250 million fund. And the question is like, is the juice worth the squeeze?
Yeah.
Is it worth it to go meet 200, 300, 400 managers with the hope that you identify and select the small set that dramatically outperform? Or should you just say, hey, I'm going to give it to a fund of funds and let them do it? Or just say, we're just going to ignore this portion of the market, and whoever emerges from this primordial soup, when they get to the point that they're raising a bigger fund, because that's typically what happens, we will like engage with them then.
It sounds like there needs to be separate people within the LP shop that actually handle these different strategies. And if it's a LP shop that is actually like pretty low on headcount, it's just going to be incredibly hard for them.
I've asked a bunch of my LPs, I'm like, is there a fund size at which you would move the analysis of your big venture relationships into your buyout PE team?
Yeah.
And I haven't gotten a satisfactory answer from anybody yet.
They just hang up?
They usually just look, they usually just stare back at me blankly like, why are you asking me this question?
They're like, your fund isn't close to that.
Right. Think about like, at some point, those firms, like, there is a certain law of gravity on returns.
Yep.
And at some point, it's probably more appropriate to judge, at a minimum, the later stage and growth components of those funds against buyout and PE targets as opposed to venture targets.
Yeah.
So, but I mean, I always remind myself, this all happened so fast. And Andreessen Horowitz is like a 14 or 15-year-old fund. And they have, I'll probably get this wrong, $60 or $70 billion under. They're the second biggest, I think last time I checked, second biggest AUM venture firm in our industry after Sequoia.
Yep.
And they've done it in under 2 decades. That's unprecedented.
Talk about speed running.
Talk about speed running, right? Like it's unprecedented. And I think I'm actually sympathetic to LPs. They're also trying to make sense of all of this too. Firms that they were very comfortable with at 500 to $1 billion, and maybe were like, okay, at 2 to 3, I can kind of see how it works. Now some of these firms are at 5, 6, 7 billion. They're trying to figure out in real time too, like, does this work?
Yeah. Yep. So when you walk into these meetings, so we will have on the date of this conversation, put out our first emerging fund manager benchmarks. So like we're trying to give a little bit more information to early stage managers about what good looks like, what the metrics say, the core TVPI, et cetera. What else do you take into a meeting, let's say with a new LP that you haven't had a pre-existing relationship with, where you're saying, all right, here is how fund 2 or 3 performed, and here's why you need to back it.
So there's one other thing that I talk to my LPs about a lot is, when I started, I looked at our data. I think something like half of the pre-seed rounds I did in Fund 1 were price rounds. Not anymore. As you've seen in your data. I mean, your data, like, it's funny. I use your data a lot because our LPs are like, are you sure it's not just your portfolio? I'm like, our portfolio is pretty big, but in case you're wondering, here is a more authoritative source.
Well, thank you. We appreciate it.
And your data is excellent. And everyone if you're not subscribing and following on LinkedIn and getting in your inbox, you're missing out. I will say this, like, it's been interesting. We have companies in some cases that have gone 4 years in between priced round financings. And our internal valuation policy, it's what ties to audit, it ties to what we publish to our LPs, is that we do not mark up safes.
You hold them,
We carry at cost until they convert. And so you end up with this weird dynamic where the companies that aren't doing well get written down.
Yep.
And the companies that are doing well, you add more dollars to the balance sheet at cost, and you effectively get no credit for that.
Yes.
In the pre-SVB world, I found LPs were like early stage investing, TVPI, DPI, like it all comes out in the back third of your fund life cycle. It's all academic until then.
Yeah.
In a world where like liquidity's at a premium, I found LPs asking a lot more questions about valuations, and we've had to spend a lot more time explaining to people, this is the mark, and this is what we think the underlying position is probably worth.
Yeah.
And that's
you
hard.
have a shadow book.
You have and we have like, I tell them like, we'll give you a forecast. Like if you believe that the post 2022 safe prices in the portfolio are directionally correct with a discount for other things that are unknown.
Yeah.
It's actually a pretty, in some cases it's like 5-6x swing at a position level.
Why do you think that so many investors are unwilling to push their founders to price rounds then?
I have asked so many people this, and I have not gotten.
Because it's not necessarily, I mean, I get the anti-dilution on safes, I get the side letters, like it's faster.
It's faster.
But is it, it does seem to strike me from the investor perspective as odd that investors would be so happy to do safes.
I think we're still living in a low friction world. And I think a couple of things. I would say when I started Precursor, we could do a price round for 15, 20 grand if it was very clean and vanilla.
Sounds pretty nice.
I know. I think with inflation now, they're more like 25 or 50. So that's like real money.
Totally.
They're also slower, and they're slower for a good reason because you have to hash out board, investor, you have to hash out all of these like really important.
Let alone syndicating it to get the whole crew on board at the same time so that you actually sign the docs. You're not signing a safe here and a safe there.
And I think most people have just been like, I'm kind of indifferent. And the other thing is like, if you're coming on board as this, it's one thing if you're like, hey, I'm a pre-seed investor. We did the pre-seed on a safe. Then we did the seed on a safe. And we did the seed extension on a safe. If you're the seed extension investor who's net new, you're like, this is my first safe.
Yeah,
I don't care.
Right.
If you're me, you're like, this is my third safe. I kind of care
for a while. It'd be great to be on the cap table at this point. Yeah.
And I think what ends up happening is there's a set of investors who are like, well, this is, from my point of view, this is the first safe. Right. And also those investors can run the pro forma and say, well, this is what the cap table looks like. I think the bigger challenge I've seen is many founders don't run the pro forma.
Yes.
And then they forget, oh, we're going to actually add a 10 or 20% option pool on top. Yep. And when it finally converts and you do the cascading waterfall, they look at their ownership and they're like, where did it all go? I'm like, well, that like you sold it along the way. You just didn't feel the pain.
We see it all the time.
You must see it all the time on the cap table product.
It is the like new pain point with early stage fundraising is ownership through safes. Not just the fact that you probably, if you're not using the pro forma tool, are not modeling in the employee option pool, et cetera. Also just the fact that you gave anti-dilution for free.
Yep.
Right. So it's like, it's not, if it was back in the day and you were doing a price round, you would negotiate that term incredibly hard. You probably wouldn't give it to most of your investors. And now it's passed along for free to everyone until you start the clock with your first price round financing.
And it's interesting. I remember when the post-money safe first came out, I was like, I don't think people really understand. Like
YC did.
And I think investors understood, like, this is great. I understand, like, on a post-money basis, the price I'm buying into, so I have a much better sense of what my ownership will. I don't think founders really fully process, well, what happens if I start raising all of this money on a post-money? I just think
it's trading dilution for certainty.
Yep.
And even that certainty isn't that certain for the founders, or perhaps not as transparent as it could be, which is an issue. But okay, but back to, so then when you're talking to LPs, are they saying, Charles, you should, that this safe, that this seed extension that you're talking about, that was from a tier 1 fund, you should mark it up? Do they want you to change your marks?
I think and who knows, this is a hard one to answer. I think what they really want to know is like, what do you actually think? Like, first of all, like, hey, we appreciate that your numbers tie.
Yep.
We can recreate the MOIC and TVPI numbers based on your statements. Good.
That's ahead of more than
Yeah.
you're saying. Yeah.
The question is like, what do you think this stuff is actually worth?
Yeah.
And for my answer is, I was like, I still am not entirely sure. I can tell you directionally, this company is worth more than the price where we're holding it.
Yep.
It's worth more than where it's marked. But again, like, it's a Series A stage company. It could be the modal is zero, as you mentioned earlier. So historically, I've always been hesitant to make forecasts.
Yeah.
Because I'm like, I'm going to give you this forecast. You're going to stick it in your CRM system.
Yep.
And 2 years later, you're going to say, line by line.
So they're going to hold you to it. Yeah.
I assume they will. I would. If a founder gave me a forecast,
Yep.
like, well, 2 years ago, you told me you were going to do 2 million ARR and we're at 150.
Yep.
This is the problem.
Those are different.
It was different. So I've always felt like I've been hesitant to make forecasts because I don't know to the upside or downside what's going to happen. And in this environment, I think also I realized a lot of LPs I've talked to, they're like, well, where do you have this position? I tell them, I was like, where does everyone else have it? They're like, we have it all. We have it in 7 different funds and none of you guys agree.
They all hold it at different
Yeah, none of you guys agree. This guy's at last round. This person's at cost. This person's at zero. They're like, no, there's no.
Mm. And so the challenge on their end is, who do I trust?
And there's some funds that they've been with it a long time. Like, well, these people always have it at cost, but we know that they're always conservative.
Right. So we trust them more. Prove that out.
But
is there an auditor perspective here too that matters, or not really?
There is. Like, all of our funds are audited, and we talk to our auditors. And I think this is the other thing that's been challenging is earlier in the life of Precursor, there were enough price round financings that marks didn't get stale.
Yeah.
Like, you didn't go. Now we have some companies I'm just like, well, this company's at, we'll call it 100 million in ARR, but hasn't raised a price round in 4 years. Private multiples are here.
Yeah.
Public multiples are over here. Even with liquidity, this, like, what's the right number?
They've honestly never been more weird.
Never been more.
Like, they're just like, and you read something one day or the next day and you're like, well, this is good or incredibly bad. I don't know.
And I've told I've always said, I just don't want to disappoint my LPs. So I would rather have some embedded value in the portfolio that isn't reflected in the statement that we feel good about to the upside.
Yeah.
Than to like, but I'm an LP in a few funds where the managers mark things up based on safes.
Yep.
And they give you this is what the synthetic, now they have all these different words for it. Mm. Like, this is what this position would be worth if the most recent safe was right. I'm like, what about the dilution on conversion? No, we're not factoring that. I'm like, I'm going to slash 30 or 40. But
was that safe by? Oh, it was an industry advisor.
Yeah.
Who came in for $15K.
Exactly.
Yeah. But it was kind of a friend of a friend. No, don't worry about it. Yeah.
So we're sort of a little bit in uncharted territory because before the market solved most of these problems for us. And now I assume it takes 4 years to get to Series A and a minimum of 2 financings, maybe 3 in some cases.
Yep.
And so I've told LPs, like, we're just going to hold things on our books that cost for longer. And it's my job to give you more insight and comfort around like what the underlying portfolio is actually worth.
And then you get a ton of different questions depending on the type of LP.
Yes, I do.
So you do a lot more explaining to your high net worth individuals than you do institutions, or is it the reverse?
Actually, like the thing I've learned, and this is maybe like a little inside baseball, we have some LPs.
We're inside baseball. We're in the diamond.
And we have some LPs whose primary concern is maximization of total capital returned over the lifetime of the fund, independent of timing.
Huh.
So we have some like endowments where like their level of time sensitivity is lower because they don't have big payout numbers.
Right.
And they assume that the organization they represent will be as an infinite lifetime.
Yeah.
So they're like, if it takes another year, but we get another half a turn,
right,
I would take that trade.
So they're not pushing for any strategic acquisitions at the moment.
They're generally would prefer money back sooner, but they're like not at the expense of the long-term thing. Right. I find a lot of our family office LPs too are sort of like the family has money forever. Like, and we have other LPs who candidly, like, their internal metric that they're judged on is more of an IRR metric.
Yeah. And
so the timing of when the cash flows arrive matters. When you mark things up or mark them down, like, they're much more sensitive. I tell everyone, we're all going to get to the same destination. Some people are going to be on a flat road and some people are going to be on a bumpy road.
Yeah.
And I think for some people on the IRR side, like, they don't want the bumpy road.
Yeah.
And
I guess there also is a risk that if you turn off and stop at the rest stop, that road could have actually gone somewhere pretty magical. You turned it off too early.
And this is the challenge, is that like right now we're in an environment where there's tremendous pressure to distribute capital back, which could give you the incentive to be more aggressive in selling, even in positions where you have long-term conviction. And I hope the takeaway, this is my takeaway, and I hope this is the takeaway for a lot of people. Many of us didn't sell enough in 2020 or 2021, myself included. I've been very clear with my LPs. There's positions we should have been more aggressive in liquidating, and we didn't. And that lesson is not lost on me. But the answer isn't to then go to selling everything.
Right. Yeah. That's actually the opposite.
That's the opposite. Right. And like I've candidly learned a lot from the folks at Union Square and the folks at Freestyle and some of my other friends who've been like, this is how we think about secondary selling and liquidity. And they have really good principles and practices, some of which we've started to adopt at Precursor. And I think like it's funny, as an optimistic early stage VC, selling isn't the thing you think about.
That's not why you're here.
And also in 2021, like if you just held, like I think about DoorDash going from 1 to 3, like if you simply just held some of your best positions in 2020 and 2021 and they made it to public and they were good companies, the compounding that happened in that last year was probably 80% of the value.
Yeah, that's wild. Yeah. But you don't know. You can't know.
You can't know. And like, so I don't know. We've tried to get better at the selling. We've tried to get better at the selling part of the business.
Yeah.
And I think everybody I know who's a seed and pre-seed, first of all, when I started in venture, you didn't have the chance to sell.
Yeah.
You had to hold to maturity. And so a lot of us are like learning the discipline of like when to sell and how much to sell and why, and how do you communicate that to founders, and like.
Do you think that there's an opportunity for more innovation in that sort of space?
A while back, I wrote a post that started off as an internal letter to all of my LPs. I ended up posting it, which is, there's only 100 points of equity. And private equity sort of figured out they sell to each other.
Mm-hmm.
And I was like, well, if the big funds need a lot of ownership and small funds increasingly need a lot of ownership, and there's only 100% to go around, eventually it's inevitable that funds like mine are going to have to sell in the B and the C. And we've started doing this to some extent. And this year, there are times where there are richly valued, highly competitive Bs and Cs. And I'm like, this is a situation where for the good of the syndicate and the good of our LPs, the right decision for Precursor is to sell a portion of our stake into this round, liquidate that, distribute it back, takes the pressure off the founder of having to find a way to like meet the needs of this like ownership-oriented new investor. And this needs to become normalized and good, that like early stage funds sell pre-IPO and likely to the person who's leading or trying to accumulate a position in a good company.
Yeah.
I don't see any other way to solve this problem.
But that only thing needs to change there would be just the mores around venture, right?
Mm-hmm.
It's the same thing with founder secondaries, or it used to be. I guess that's also
we've solved that problem,
right? Of like, well, if you sell at the A or the B, you don't believe in this, and it's like, well, no, this is the economics dictate this in some way, shape, or form.
And I think dumping your whole position in the B, they're probably not constructive unless you're an angel. I think if you're an angel, you have different rules. And so we've been talking to founders about, okay, well, how much could we sell without upsetting the apple cart, without making you think we've lost faith in the company? But also, I think it's also part of my job as an investor to explain to founders, this is my business.
Yeah.
This is how my business works. Me selling has more to do with an overall objective I'm trying to achieve for my limited partners than any like knock on your company.
It's not you, it's me.
Yeah, it is. In many cases, it is.
Yeah, for sure.
Truthfully, the only chance you get to sell are in the companies that are actually doing well.
Correct.
Where there's excess demand.
Yeah.
So
that's not going to be the case if something is truly struggling.
Totally.
Right? That's going to be what part of the conversation. You root for the first conversation.
That's right.
Rather than the latter one. Okay, Charles, speed round questions.
Yes.
Before we get you out of here. First one, most interesting sector or subsector that's fascinating you lately for investment?
Wow. We're so generalist. I will say I've been spending more time in ag.
Ag?
We have a couple of companies in ag that are doing well. And in talking to those companies, I'm beginning to understand the kinds of technology products that you can sell to agriculture that they will buy. So that's been a sector where I've just seen a bunch of interesting, that isn't like the obvious ones like fintech, digital.
Sure.
That's one where I've been like spending more time and seeing more interesting things.
That's the first time that's come up. So Unique. Well done. Okay. Second question. The most unique way that you or another GP that you respect has helped or brought value to a portfolio company?
The this is like really specific.
Even better.
I have someone I co-invest with a lot, where we had a company that we both believed in, but the market just didn't love it. And we were having a hard time raising this round. And this person like got on a plane and went and saw his biggest LP and said, I need you to do a direct co-invest in this company. And it's not hot.
Right.
This isn't like,
this is not going to be an easy choice.
It's not going to be an easy choice for you, but like all of the insiders like deeply believe in this company. And like, I'm basically asking you to do this for me because you trust my judgment.
Yeah.
And I'm coming to you because the market doesn't get it.
Yeah.
Which anyone who runs a fund knows that's an incredibly risky.
Absolutely.
Putting all of your like social capital with your LPs in, and he did it, and the company's doing great, and it like worked out. But like he decided to do that without us being like, somebody's got to like take the.
There wasn't like a pick a straw. No, your LPs.
He had that much conviction, and I think the founder, once we explained to the founder how rare that is, the person was like, oh, he really like went to bat. Yeah,
respect.
It was pretty cool.
All right, last one. The number one question that you wish founders asked you when they're fundraising that you just don't get asked enough.
What will we have to do to get another check from you in the future? Because I think so much of the focus is on like, because like, you know, like this happens every time. It's like, this is what we're going to do. We're going to take this $1 million. We're going to get to Series A. I'm like, okay, no, you won't. Like you probably actually statistically won't get there. Even if like we're going to raise this $3 million seed round, we're going to get to A, also statistically like unlikely.
Correct.
And I think a lot of times I ask people the sort of the inverse question, which is like, what's the most important thing we need to prove with this money to know that we should keep going? And I wish founders would ask me that, because oftentimes it's very clarifying for me. I'm like, oh, if you proved this, I would continue to invest in the business independent of what the market tells me. And if we don't answer that question, the other one I would say is like, sometimes people do ask me this, more people should, like, what's the like biggest clue you get that a company is working? And I'm like, oh, it's product velocity in the first 6 months. Easy. Like the people where the money makes a difference quickly are generally successful.
On the first question, do you have a good answer when always in your head already when they ask you, what will we need to do to get another check from them?
It's a mix of quantitative performance, and then there's like qualitative stuff like, be a good communicator about the state of the business. Be honest with me about what's going well and what isn't.
Yeah.
Take ownership for the things that are management responsibilities, and like come to me with the things where you think I can be helpful. Even if the answer is like there's nothing, that's actually an acceptable answer. I don't know. I've had a few people who've come to me and they've been like, well, we need a bridge immediately. I'm like, I just talked to you last month and this didn't come up.
That's a problem.
Did we spend all of the money in that month, or did this just like, and
they're like, no, genuinely, we spent all the money. I'm sorry.
Those I understand, but I do feel like there's a certain, one thing I like tell a bunch of founders is like, you need to make a decision about how much you want to invest in investor relations.
Yeah.
Like the more time you spend getting to know your investors and keeping them informed, the easier it will be when things are hard. But it's not free time.
Yeah.
It actually takes time. So you can decide where you want to put the slider. And if you put the slider on 0 and something goes wrong, you're going to get the 0 slider outcome. And if you put the slider at 75, you're going to have a different outcome. But you have to decide it's worth spending.
But it could be wasted time.
It could be wasted time.
Right.
It could be wasted time.
But it probably won't be. All right, Charles, changing gears for a second here.
Yeah.
You recently ended a term as, was it board president?
Board chair.
Board chair of the NVCA. Congratulations on being done.
Thank you. Thank you.
But what was that experience like? Because I think it's actually pretty rare that you get to be involved in the policy level for your industry.
It was honestly, I miss it, and I know Byron Dieter from Bessemer will do a great job.
Yep.
It's an amazing experience because, you know, when I joined the NVC as a board member before I was chair, I was like, how does this trade industry work? Is this just really for the big coastal funds, and like the rest of us are here just to like wave and be
fill out the seats?
And it turns out many things I learned. Number one, the policy set of issues for venture is like far greater than I think a lot of people are like, oh, is this all about tax? I mean, tax is part of it, but tax is by no means the thing we spent most of our time talking about. Things I learned that were like noteworthy to me. There are tons of issues impacting smaller regional funds around the way that they raise capital that are policy-driven issues. And just talking to life sciences funds about like, hey, there's things like non-operating laws, like March, all these policy things that are very germane to healthcare and life sciences that I knew nothing about, that I got to experience. There were the experiences of like I said, smaller emerging manager funds in the Midwest and in the Rockies and other places that were facing very different issues than coastal emerging managers when it comes to raising capital, including like our local banking system is prohibited from giving us capital, or the accredited investor limits create thresholds, create issues. The other thing I realized, and we talked about this a little bit off mic, is you go to Washington and these people are bombarded with thousands of issues. And venture capital, while it's a big industry, our trade association isn't like one of the biggest. We're not telecom. We're not real estate agent. Like, we're pretty small. So we're not necessarily top of mind for people. And for some people, they're like, well, what's the difference between a hedge fund, a private equity fund, and a venture fund? Any VC would bristle at that and say there would. But oftentimes, what we found was that legislators were drafting rules and bills designed to deal with problems maybe in hedge fund or buyout, and inadvertently creating collateral damage in venture
because it just wasn't specific.
It wasn't specific enough, and they're like, well, these people are all the same. We're like, but we don't do that thing. Like, we're different from them in that era, which is not to say that we don't have common interests and common challenges. And so it really gave me a sense of like the importance of showing up. And I think, there are a lot of people I talk to in venture who are like, I don't like politics and I don't like DC and it's gross. And I'm like, this is where laws get made. Yeah. These laws are going to get made, or you have two choices. You can participate in the process and try to have influence. And having influence doesn't have to be like some icky, gross thing. It can be just going and stating your case. And one thing that was like really illuminating to me was I found that when a lot of people I met on the Hill met emerging managers who were entrepreneurs themselves, who were putting substantial amounts of their personal wealth on the line, it just felt different. That was not like your rich fat cat perception. And they'd be like, oh, this is the person that I'm going to impact with this legislation. This person in Minnesota or Iowa or Chicago who's trying to start a $15 million venture fund to fund entrepreneurs in our local ecosystem. I'm going to make this business more difficult for that person. Oh, that wasn't my intent.
Yeah.
So in many cases, I was like, the things that are happening to venture are not intentional. We are collateral damage. We need to go make the case to folks that, hey, if you do this thing this way, and obviously the SEC stuff we did last year was a big part of that.
Yep.
Was a lot of those proposals. I mean, these will negatively. I mean, the big aha for me was I was surprised when they picked me as chair. I'm not gonna lie, Peter. I'm like, I run a teeny tiny venture fund in the grand scheme of our business. Why would you choose such a small fund to chair the industry? And I give the team a lot of credit. I think they wanted somebody who was going to bring the perspective of the small fund manager to the chairmanship, and I succeeded by a fund that's much larger than mine. It's preceded by a fund that's much larger.
Maybe you've solved the issues, right? And
yeah. And I think the thing I came to realize is that like the NVCA really is the trade industry for everybody in our industry. Like, it's as important to deal with the CFIUS issues that impact the big funds as it is to the small accredited investor issues that impact, or the difference between being a registered investment advisor and exempt advisor. Like, these are issues that are very material to small funds. And I had no appreciation for how many near misses in policy land happen, but for the intervention of someone saying, before you do that, let me give you one more perspective.
Right.
Before you put that language in that bill, let me tell you like the unintended consequence. And I think most of the lawmakers I met were very well-meaning people. And when you explain to them, this is an unintended consequence of what you want to do, they're oftentimes like, oh, I'm glad you know. Sometimes
I didn't know that. Yeah.
Sometimes like, I didn't know that and I don't care.
Right.
But in many cases, they're like, I didn't know that and that's not my intent.
Right.
So maybe we can change things to avoid that outcome.
Yeah. What would you say to emerging managers in terms of their ability to get involved in policy? I'm sure that they're like, well, I have 1,000 other things, Charles, to think about. So
Precursor was like a 5-year-old firm when I got involved with the NVCA. I like literally didn't have the time to do it. It just felt it was really important to be a part of it. What I will say is I honestly think the best ambassadors for our industry are emerging managers. They are the most sympathetic, kind of heroic figures we can put forward in our industry, because they're people who are betting on themselves with their money and time. And I think like I have not met someone in the legislative process who doesn't want more entrepreneurial vitality in America.
Right.
No matter what party you're on, no matter what I think everyone says, yeah, I want more entrepreneurial vitality in America. That's what makes America, part of what makes America special is our entrepreneurial vitality. And telling people that like, hey, these people will someday become the next generation of big funds. And if you want to nurture that, if you want that creativity, you have to make starting these things attractive. It doesn't mean you can't tinker at the margins, but you can't do things that discourage people from creating new funds and funding entrepreneurs.
Yeah. Well said.
Thank you.
Charles, this has been an absolutely fascinating conversation. Thank you so much for coming.
This was really a pleasure. I really enjoyed this.
We'll do it again soon.
Can't wait.
Cheers.